All right, everybody. So let's just get started in talking about if you were just starting off from scratch, or even if you've been investing for the past 1 to 2 years, really what's the best thing that you can do, the top five things that you can do to better your investment journey. And so I think a lot of people struggle with this. They really just jump both feet into the pool. They don't necessarily know what they're doing. They try a bunch of things out. And I actually do recommend giving yourself a little bit of grace with respect to understanding what works and what doesn't work. But at the end of the day, I think one thing that everyone fails to truly do is really create an investment strategy and really think about and understand what their plans are in terms of what they're going to do during certain aspects. And it doesn't necessarily mean that that can't change as your portfolio and as you yourself mature. But the thing that bothers me the most is people will willingly go and try whatever the latest cool thing is to do, whether it's selling cash secured puts or selling options or even buying leaps or this, that, or the other without fully recognizing or truly understanding what is the true goal or objective of each of those individual items on their own. And so they might end up getting themselves into trouble, whether they didn't really fully recognize or comprehend the risks that were there. And they might end up doing something because they have a little bit of knowledge of something, but they don't have the full knowledge of something. Now, this always just goes back to trying to fully understand where you are in your investment journey and what your true objectives are, and always having a firm foundation. And so this is the top five things that I recommend everybody does. They get out a pen and pencil and hopefully walk through this. And as I noted, you don't know what you don't know as a beginning investor. And so this might morph over time. This might allow you to kind of get a fundamental idea as to what you want to do, but at the end of the day, you might learn something about yourself. You might have a windfall come in, and you might end up having some different changes going on in your portfolio as it matures, and that's perfectly okay. But the hope is that with a firm foundation in these top five things, you can at least have a goal in mind, and you're not fondling the portfolio to the point where you lose efficiencies. And that's really the biggest thing, is think of it like a bar of soap, right? Like the more you play with it, the more it's just going to disintegrate into thin air. And you don't want to do that, right? It's just going to circle down the drain, and you don't want that. So to me, this is the top five things. And if anybody's listening to this, I hope you have a pen and paper and you contemplate this. Talk about it with your spouse, talk about it with friends, etc., and really try to hone in on this. And it wasn't until I fully understood and got a little bit further into my investment journey where I truly comprehended this and digested this. So I'm hoping that this shaves off years off your investment journey, really trying to understand what your goals, objectives, and everything are. So, number one, I would encourage everybody to start off with what I've been chatting about pretty much for the past 2 to 3 minutes, which is what's your objective, right? What are you trying to accomplish out of the portfolio? Now, it's not to mean you can't have different portfolios that have different objectives, but for the main overall goal for yourself as a person, as a business, what exactly are you going after? And that could be, you want to have 8 figures, right? You want to get to a place where you're financially free and you don't necessarily have to work on a 9 to 5 job, or you have the ability to retire slightly early. Those are all good objectives, but with that, there's underlying details, the next 4 to 5 things I'm going to outline, that really help understand and underpin that objective. And second, and probably the most important, is your time horizon, right? It's going to be much easier to say, I want to get to 8 figures over the course of the next 20, 30 years than it is to be like, I'm going to YOLO into this portfolio and do it tomorrow, right? You're going to go into completely different investments if you have an idea as to what you're going to go after. Now, this is going to be pretty blunt, but you're probably not going to invest in AT&T if you want to be 8 figures within the next 24 hours, right? You're going to have to come up with some brilliant plan and have to kind of sell it to a bunch of different folks and really hustle. You probably can't do that with the stock market, right? So there's a bunch of different avenues that you can do to get to that 8 figure mark, but you have to understand where it's realistic within your time horizon. So that's very important, right? And that can kind of outline what you want to do with respect to the portfolio and what kind of investments you might be looking for, right? You might be a little bit more lenient on this third thing that I'm going to mention if you have a little bit more time, or you might have to go a little bit more, um, I guess, risk on if you want to for this third thing, if you want to potentially have outsized returns. Now it could also lead to outsized losses depending on what you're getting yourself into. And so that brings to the third thing. Obviously, I kind of already pre noted it, which is risk. How do you feel about it? Right? Do you hate waking up and seeing red on the screen, or do you think that that is just a natural piece of doing business and you're okay with it? Now, it's not to say that you are completely careless about it or anything like that, but I just think as humans, we generally speaking are rather optimist creatures, and we generally speaking undervalue or understate the risks that are at hand. And I see this quite often. People just always look to the upside. They don't truly fully comprehend the complete downsides or the black swan events that could occur in the stock market. And that leads to jerk reactions. That leads to people selling early on certain things when they could potentially have waited and potentially come out on the other side. I've had notable events where people look at just macroeconomic risks, not even single company risks, and they sell something like as great of a company as Google when it had the whole market pulls back 20-30%, and they freaked out thinking it was just Google, right? And it just requires a little bit of poise, and it requires a little bit of emotional control to make sure you don't make these rash decisions, right? Is Google actually going to be different now than it was 3 or 4 months ago before it dipped 20%, or is it a whole broader market sort of impact? So that's a piece that I want people to look at. But you also have to recognize there's no way for you to, like, going back to that initial example, you want to turn in 8 figures overnight. You can't do that with a very low risk asset, right? High risk, high reward. Everyone kind of hears that, but you have to evaluate what's risk within reason for your portfolio, and what your tolerance is. Otherwise, you could lead to a rash decision, like I noted, and end up with severe losses and get yourself completely frustrated with, say, the stock market, real estate, or what have you. The idea of additional contributions and how much you want to put into the market on a regular basis. You're going to invest completely differently if you have $1,000 and you want to get to this 8 figure goal than if you have $1,000 coming in every single month. And a funny thing that I like to say, but I hope this hits home for people, is if you have $1,000 and you want to turn it into $1,000,000, you have to 1,000x your money. Well, what's the easiest way to half the amount of work that your money has to do? And that's to add another $1,000 to the portfolio. Going from 1,000 to 1,000,000 is 1,000x. Going from 2,000 to 1,000,000 is 500x. You have to have the amount of work that your money has to do. And so if you think about it on the third month, if you add another $1,000, you only have to 330x your money comparatively to the first month. So now your money literally has to work one third as hard just by having that consistency and adding contributions. And I think that's very powerful. And I think a lot of people don't think that way. And that's a very millionaire mindset sort of thing to think about, that most people just completely blow out of the water. They say, here's my $5,000. I'm going to turn this $5,000 into 1,000,000. And really, it's the baby steps of adding 250, 500, $1,000 every month that really gets you into that millionaire mindset, right? It's that frugality and understanding the value and time of money to get you to where you need to go. And then fifth, how active or passive do you want to be in this investment, right? And I think a lot of people think that they can be the next Warren Buffett and choose stocks, when in reality, Warren Buffett's looking at the 60, 80 hours a week, and he's kind of known as the one of the best of all time in that respect. So if you think you could dedicate 60 to 80 hours a week, then maybe this is your kind of game and choosing stocks or what have you. But at the end of the day, you have to recognize that you have to put some sort of sweat equity if you want to be engaging in above average market returns. An above average market meaning the S&P 500 or just buy and hold real estate, everything kind of has its price with respect to sweat equity and things of the nature of that. So just keep in mind that you really have to be thinking wholly about what you're trying to get into and why, right? If you're investing in the stock, not only do you have to buy it low, but you often have to sell it high. And so are you actually paying attention? And I think that this is a prime example that I try to tell to people, because initially I started investing in God knows what penny stocks, right? And of course, we lose a little bit of money trying to do that when you have absolutely no idea what you're doing in the stock market. So this goes back to 2012, 2013, when $100 was a lot to me, right? And it still is in that respect, right? You always have to mind your dollars and cents. But the thing that I was recognizing was assuming just because it was below a dollar that it could have the opportunity to go to $10 or $20. And that's not always necessarily the case, right? There's so many different nuances that you have to understand. But at the same time, I was trying to day trade. And here you are, the market just opens 8:30 because I'm on Central Time. And I'm looking at it, trying to make my dollar here, dollar there. And next thing you know, Matt, 9 o'clock, we got to go to the 9 a.m. meeting. Well, crap. What am I gonna do? I have to be stuck in this meeting. Can't be on my phone. Can't be on my laptop the whole hour. Have to be participating. I'm leading the meeting for God's sake. So you're stuck. How can you be a day trader if you have to be in these morning meetings? You're in a 9 to 5 job. So keep in mind, what type of investment you're looking to make. Are you looking more, long term, long dated? Or are you looking to be short term dated, 0 day options? Things of the like. There's a whole range and spectrum of different investment opportunities, whether it's the stock market, real estate, etc. And you have to be realistic with what your returns are for that. Now, let me give you a prime example. Somebody could say they have a 20-year time horizon to make $1 million, and they just want to be extremely passive. They have an okay risk tolerance, but they're probably not going to look at this thing more than twice a year. And they're planning on adding $500 to $1,000 a month. And to me, that's reasonable. That's probably a lot of people, probably 90, 95% of you people that are watching this fit into that realm. Now, the thing that I would encourage people to do, if that's the case, invest in an index fund, S&P 500, or maybe 90% S&P, 10% cash. And as you get a little bit older, rebalance that to be more focused around, some bonds or some lower volatility assets. I don't necessarily follow the bond thing. I think if you save up enough in the short term, then in the long term, you probably won't have to worry about the bonds. You'll be fine with the volatility throughout your retirement. But that's just my point of view. And then there's the people that say, Matt, I need the above average returns. Well, then you need to specialize into something, right? You can't just assume that you're going to show up and be the master of the stock market without putting in hours upon hours of work and understanding the nuances. And even me, somebody that's been investing for 10 years, knows probably nothing about the entirety of the nuances of the stock market, the different ways and avenues in which you can utilize it to your advantage or to utilize it to your skill set. And so I'm still learning, even after 10, 11 years of investing. And here I am trying to convey to you that you don't know what you don't know. There's always going to be underlying risks that you can't quantify. But if you want to try to be more successful, outpace the market, then you have to put in the time and effort, or at least figure out some sort of advantage, and that's difficult, right? If everyone could find an advantage, everyone could outpace the market. And in another way that you could look at it is maybe you have a skill, a carpentry skill. Maybe you're a contractor, and you can buy your own real estate and turn it over rather than paying somebody else and being able to pay for materials plus a 30% markup. Maybe you could buy those materials yourselves and flip a home, and you can do that in relatively quick fashion because you have that expertise. You could probably get above average market returns for that. But you have to realize, you can't just show up and become an expert contractor, an expert carpenter. That takes time. So I just hope people recognize and take this opportunity to write down those 5 things: objective, time horizon, risk tolerance, how much capital and contribution you're adding on, and what frequency, and how active or passive you want to be, and truly start to understand where they fit in the realm. Obviously, if you work a 9 to 5 job, you can't be a day trader, right? Maybe if you lose your job, you have a little bit of time in your hands, you can give it a go. But generally speaking, people trip and fall on their face when they try to do something like that. So it takes a little bit of time, and it's okay to be in index funds. In fact, I think it's more noble for people to recognize they don't have the time and they'd rather just invest in index funds and let the S&P 500 take a hold. And the last thing before I sign off, I recommend the S&P rather than the Qs. first and foremost because I like the S&P because it's guaranteed profitable companies. It's the top 500 largest companies in the S&P that are profitable. The Nasdaq 100 doesn't have that profitable criteria to it, and so it leads to a little bit more volatility when it comes to the stock market, right? Yes, it might go up during bull markets, but it might go down more in bear markets. And so you kind of have to keep in mind that impact to the volatility of what you're kind of investing in. And so that lower volatility to me means that the S&P 500 is probably more mature. You're also going to get a slightly better dividend in that respect, and so that might mean something to somebody that is starting to get a little bit older. And so that short term say loss in terms of volatility and potential return in the long term could yield the fact that you don't sell out, you don't get nervous during pullbacks, all that sort of stuff. That lower risk and volatility during times of bear markets is really going to play a factor into certain things. So that's a little bit of my thought process. A little 16-minute video. Hopefully, it helps some of you guys. And at the end of the day, just here to try to help people. Feel free to reach out to me, become a member, join our WhatsApp group, what have you. More than happy to help you in any way, shape, or form that I can. Feel free to follow me on X as well, and let me know how I can help. Okay, cool. No, this is a little bit different, atypical of some of my videos, but it's kind of roots to what the channel started off as. And really hope that this finds you guys well, and I will talk to you guys soon. Cheers.